EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It matters because it's a metric that's commonly used to measure a company's operating performance on a normalized basis. It can be considered a proxy for cash flow from a company, although it is often not a very good proxy at all, which we'll discuss more later. It removes items from earnings that business managers have some discretion over, for example, debt financing and capital expenditures. It showcases a firm's financial performance without taking into account its capital structure or capital expenditure requirements. Let's look at the EBITDA formula. Starting at the bottom of the income statement, you can take net income and simply add back interest and taxes, plus depreciation and amortization, although you may have to go to the cash flow statement to find D&A, depending on the company. A quicker form is to take EBIT and just add back D&A. Now let's look at an example together. Here's an income statement for a company, and you'll notice that it does not explicitly break out depreciation and amortization on this income statement. So instead, the analyst is going to have to go to the company's cash flow statement, where it discovers that they include $20,000 of D&A under their operating expenses that are add back because it's non-cash. So let's calculate the company's EBITDA. We start at the bottom of the income statement, add back taxes, add back interest, and then we go to the cash flow statement to add back $20,000 of D&A. So here is the full formula, and the total is $75,000. Let's discuss the pros and cons of using EBITDA. Those who are in favor of it like it because they consider it a proxy for cash flow. It makes different companies more comparable because it removes a lot of the noise that's below operating income, including one-time items. It can give a company a valuation by multiplying it by comparable EV to EBITDA multiples. It can also be useful for companies that are not profitable yet, for earlier stage companies, or if a company is having a lot of volatility in earnings, then EBITDA smooth things out and hopefully will be positive if earnings are not positive. The cons are that it is not recognized by GAAP or IFRS. It presents the company as though it never pays taxes, interest, or capital expenditures. It shows assets as though they never lose their value or need to be reinvested in, which of course we know is not true. EBITDA is one of the most frequently quoted financial metrics, so it's important to understand these pros and cons very carefully. We hope this has been a helpful introduction to understanding EBITDA.